It's Sunday, May 1st, 2022. This is All About Your Benjamins and your weekly mixtape and weekend review. Hello, I'm back. Sorry to miss a couple weeks. The motivation to get back sooner rather than later was to see some more mixtapes floating around in the financial blogosphere, and the competitor in me, even though I view these folks as friends and not competition, the competitor in me wants to maintain wearing the crown of the mixtape king of the financial blogosphere. So the mixtape has to pick the game up. It can't slow down because there's people putting out their mixtapes as well, and I want this one to be the best and the original. So let's get to the headlines that may or may not be impacting your financial plan and portfolio. As you can see below, if you're watching this on the blog, just a handful of articles to go through, some pretty big important topics to discuss. So we'll kick off with the GDP, the gross domestic product of the US, declining for the first time since early on in the pandemic. So the GDP shrunk by 1.4%. But does that mean that it only grew at 1.4? It shrunk by 1.4. So we're still growing, which is going to keep the Federal Reserve talking about and probably raising rates so we don't grow too fast. That's part of their concern. We know inflation's out there. But one of the things also to put out there is now that we have our first quarter of declining GDP growth, the talks of recession are going to continue to pick up. So we've been hearing people talk about looking for a recession. I do think it's kind of silly to talk about looking for a recession. We know recessions are normal. We know they happen every so often. You can almost kind of throw pandemic stuff out because it's so abnormal. So it's been a while since we've had a true recession. Now, as I talk about it, I'm not looking forward to one. I don't love a recession, but I also want to normalize it and that we see these things regularly and that they're just normal part of the business cycle. Things heat up, they get too high, we got to slow back down. Two steps forward, one step back. So to be looking forward is normal, especially when we've had a number of years of growth, and the first quarter of declining growth is here. Back-to-back quarters is usually what triggers the true definition of a recession. Now, we won't know when the recession has been going on until after the fact. It's reverse looking. So we could already be in the recession. The recession will happen before we realize it. The recession will end before we realize it, and most likely any market fallout will finish and recover before we recognize it as well, which is all going to the long and tried and true investment philosophy of buying and holding, diversification, and making sure that the funds that you don't need in the short term make sure they're not tied up in the market. So that way, if the market does take a while to recover, you've got ample savings, you've got ample cash to live your life and do the things that you want to do. Now, the tricky thing with all this is usually in a portfolio, a long-term portfolio, that spot to hang out and chill in is the bonds. And if you've looked at your portfolio this year, we'll talk about that next. It's been a tough year for all investments, bonds included. So with interest rates going up, bond prices go down. So our safety net area is not so safe in the short term. Now, depending on the bonds that you're holding, you're seeing different lengths of declines, just like depending on what type of stocks you're holding or areas you're allocated to in the market, you're seeing different levels of decline. So speaking of that, let's get to the market. So we had the worst month since 2008, so we get to bring these great non-important metrics out so we can make comparisons. But nonetheless, it wasn't a good month. The NASDAQ, your tech, your growth stocks is down about 14% year to date. The S&P 500 is down, I believe, 11. Let me check my numbers real quick. Pull that back up. All right, here we go. The S&P is down 13% year to date, and the Dow is down 9% year to date. So stock markets, those numbers themselves aren't scary. You should be prepared to see declines like that in the market, but to have them, 5 months into the year now isn't the most comforting. But that's also assuming that there's no recovery in the future, or there's no bottoming out and just kind of leveling, and maybe we stay range bound for a while. So long story short, if your goals haven't changed, you're a long-term investor, this is the admission to pay that we have to pay to get the returns we've had over the last 5, 10, 15 years. So again, it doesn't make it fun. It doesn't make it a little spooky at times. You're going to have more narratives that come out how this could get worse, and maybe it does, or maybe it doesn't. We won't know until hindsight, just like we were talking about with the recession. So the best course of action historically, and I've experienced this multiple times as a financial advisor, is to stay the course and try to limit the selling of investments if you don't have to. So that is the commentary there on the market. We'll see. Hopefully May is going to kick off at least some more calm markets. Maybe it doesn't have to recover, but make it a little bit more calmer and not so volatile and having 3% down days like we had on Friday. Next up, consumer spending is up in March. So despite inflation, despite the market, despite talks of recession, consumers are still spending, which is not necessarily a bad thing. There's an article, I didn't include it this week, but incomes are still up high. There was an article I found that talked about how people changing jobs are getting 10% increases in their pay. So there's still not enough supply of workers for the demand that's out there, which is keeping wages higher and increasing, which in some respects is good. We want people making more money, and that makes people feel more secure. They go spend more money, but also higher wages also lead to inflation because those higher wages go to the prices of the goods and services being sold and raises them up as well. So it's kind of one of those things where you don't necessarily want to see people making less, but also knowing that where we are in the inflation cycle, higher wages and growing wages don't necessarily help the inflation story. Next up, consumer sentiment rebounded. So again, spending's going well, consumers are feeling better. Not a whole lot to go on that, just that the consumer sentiment in March was better, April was better. And then finally, the last article, Fidelity announced that they're going to allow Bitcoin inside 401k. So in the financial advisor space, especially those interested in crypto, this set off a lot of conversations, articles about how this is a bad idea versus a good idea, and lots of commentary around it. Nonetheless, this just signals that crypto and Bitcoin are getting more and more adoption, which I think lends to the greater importance to at least understand the space. Again, I've been investing in crypto since 2017. I've been helping clients over the last year, spent time at a startup in the crypto space. So I'm obviously a believer in it. I see the opportunities. I see it as a speculative asset class, but not so speculative that you couldn't have some in your portfolio. But I also believe that if you have a diversified portfolio, you save your money properly, you do all the right things, you can probably reach your goals without having an allocation to Bitcoin and crypto. So I don't think I'll ever become the person who says you have to have it, just like I don't think you have to have every asset class that my clients may have. I believe in it, and if clients feel like they need it, then okay. Now, to the question, is a 401k the best place for Bitcoin to be? It depends. Why are you investing in Bitcoin, and do you want to have all of the possibilities that crypto and Bitcoin allow you to have? So for instance, with your Bitcoin, you can lend it out, you can earn higher interest, there's things you can do with it, you can use it as the technology was developed to be used. But if you're not worried about that, you just want exposure to the asset class, then if you think about it, if you believe in it growing and appreciating, a 401k or even a Roth IRA may not be a bad place to hold that Bitcoin if you're just investing in it for the long-term potential of growth. Obviously, tax deferral on that growth is ideal, especially if you're rebalancing and moving things around. So I don't think a 401k is a bad place for it to be. I also think that for most people, their 401k is their largest investable asset, if not their only investable asset. So where else are they going to have the opportunity to get exposure to it? So from that standpoint, putting it into a retirement plan is not a bad thing because it gives more people exposure to the asset. And if you think about it from a asset class standpoint, it's got to be a positive because you're getting more people who are going to have access to it and potentially invest in it than may not have before. Now, yes, naturally, more people getting access to a speculative, volatile asset class, one that's going to bring FOMO to it, is definitely going to cause some people to make a bad choice, invest at the wrong time, sell, and have a negative experience when it comes to crypto. And I don't love that. But also, you can't avoid that in any investment. There's people who are doing that, looking at their 401k returns, picking the area or the fund that did the best, making a change, and it'd be at the wrong time. We don't hear about that as much because that's been going on for a long time. You add Bitcoin to the 401k plan, and that happens. Now it's new. Now it's unique. I'm saying unique with quotes to those listening. It's unique because it's Bitcoin. Well, that's what investors have been doing for a long time. The behavior gap is really well known about the gap in performance because of the behavior of people, which Bitcoin is going to bring on the 401k. So, long story short, I believe in people having options. I believe empowering people to make good financial decisions. Financial literacy sucks in America, so we haven't done a good job of that, but I don't think it's fair to prevent people from investing in an asset class that everybody has access to. Yes, they could go do it somewhere else, but maybe not everybody has that ability, and they can put a little bit into their 401k, do it responsibly, have access to this asset class if they believe in it, and not be missing out. So all in all, I think it's a positive. I think it'll create a headache for the plan sponsors and for the people who have to be the fiduciaries of the plans, but that's not my responsibility. I just think, again, giving people access to these asset classes because they're missing out on it right now, I think is only fair. So for me, from an equality standpoint, I like to see it. From an asset class standpoint, more adoption I think is only a good thing. Yes, there's going to be people who have a negative experience with Bitcoin, with their first experience being through the 401k and not doing it properly. And that's sad and that's unfortunate, but it happens with all asset classes. So the answer to that is to continue to put education out there and help people make good decisions, understand the space to try to avoid that rather than keeping it away from them. All right, so that is it for today's Week in Review video. I saw Silas just come in here, so you might hear some noise. As always, thanks for tuning in. Be sure to check the mixtape down below. You want to say hi, Silas?
Hi.
Oh, give her more. Say hi.
Hi.
Say good morning.
Good morning.
All right, can you tell them see you next week in the next episode?
See you next week.
All right. Have a great week. We'll be back next week. Check the mixtape down below. Peep the Villa illustration. That's from my other venture, Pursuit, my passion project I'm working on. If any of that messaging resonates with you, head over to pursuit.co. That's PRST.co. And check what's out going on over there. There's a newsletter as well. A little crossover between All About Your Benjamins in there, but trying to keep them separate as two separate brands with a little bit of connection. So, all right, we'll let you go for real now. Have a great week. Have a great week, and we'll see you all in the next episode.